ETFs, we have all heard of them. Many of us have traded or invested in them. Hey, everybody, Serge Berger here from the Study Wealth podcast. And I'm excited today because I've actually been talking about this for quite a while, that we're going to start having a deeper inside look in different parts of the market. In this case, we're looking at different strategies that are out there, and we're looking at this through the lens of ETFs. With me is Eric. He is from Simplify Funds, Simplify ETFs. Eric, welcome to the podcast.
Serge, great to be here.
It's wonderful to be able. I'm very much looking forward to the conversation and taking things apart from a bit of a different angle than I think people are used to. If you could give us a little bit of introduction of what you do and what is Simplify, and then I'd like to have a conversation around ETFs in general before we look at some very specific strategies that I really enjoy that you guys are doing.
Sounds great. So I'll start with an introduction to Simplify. And what we are is an ETF provider that launched in 2020 with the idea of bringing hard to reach exposures to the everyday person, including retail individual investors, but also financial advisors and institutions, through a low-cost, liquid, and transparent wrapper, right? The ETF wrapper. And we really were a team of industry veterans from across the space. I was a former financial advisor. We have some folks from the asset management business, from the hedge fund business. And we all saw this opportunity following some rule changes in 2019 and 2020 that allowed for the expansion of active ETFs. And this doesn't necessarily mean that they're ETFs like a mutual fund, right? Which is when you think of active investing, you think back to the legacy mutual fund days. But this can be a number of different strategies, some that are systematic, some that are discretionary, but again, incorporating harder to reach exposures, namely derivatives, including options, futures, swaps, etc., and then delivering them to market in products that you can buy and hold or trade. And so that's really what we launched. And then what I try and do, I try and help people understand what we do. I try and help us live up to our name. And so that puts me working with allocators across the experience spectrum to understand what expectations to have and what types of outcomes that they can look forward to.
And you guys have some terrific strategies. In fact, I know you and I touched base, I don't know, it's been 12, 24 months, something like that. And I was already aware of what you guys do, but I'm always intrigued by the markets are so multifaceted. When you look at it from a retail investor's perspective, there's tech stocks and the rest. And then maybe, if you're really open to it, there may be bonds. But there's really so many different parts of the market that I think the average do-it-yourselfer really has never even heard about. And I think some of those are really where you guys go in and focus on, which is wonderful. And that's really want to bring this to the attention of our audience. So that's what drew me to have a conversation with you. Now, when we look at the broader ETF world, obviously it's exploded in terms of growth, in terms of opportunities, really. Again, you can be very precise with your focus on an ETF. I remember when I had my first internship at UBS in the year 2000, and ETFs I was literally, and I knew nothing. I was literally still in college, and I was teaching the UBS guy that I was working with about ETFs, which is crazy to think about. And I really knew nothing. He just knew mutual funds and stocks. And so when I look back to those days where it was already a thing, fast forward 24 years, which makes me feel very old, but I've looked at how the industry has developed in terms of, again, how granular you can get. If you could speak a little bit to that, because I still think there's a lot of people, particularly do-it-yourselfers, that like to chart chase a stock up and down all day. And there's nothing wrong with doing it some of our money, of course. That's all good. But I think there still is a thought to some extent that ETFs are boring. Yet when I speak to institutional investors, when I speak to you, when I speak to professionals, I see what they do, and we do that as well over at Blue Marlin. It's really, the most of it is ETFs. There's single name stocks, of course, but maybe if you can help me clear that up a little bit, because people really do think ETFs are boring, and they're really not.
They can be boring, right? And I think sometimes boring is good for some people, and for others, they want high octane, right? And so One analogy that I would draw when thinking about investing in ETFs in particular is to view an ETF kind of like an ingredient to a meal, right? And even further, if you were to go deeper than that, you say, okay, what molecules or elements go into that particular item, right? Those would be the subholdings. But for a lot of investors, we have been rewarded by buying the dip, right? Going long stocks, whether it's the S&P 500, whether it's long tech stocks over the last decade or decade plus. But in ETFs, you can think of these different offerings that are out there away from traditional large cap beta or large cap growth as being just other parts of a well balanced diet or a well balanced meal, right? And so you may love to eat ice cream going buying high octane tech stocks, and maybe that's worked out for you for a long time. And then you start to see your waistline expand and you go, oh, maybe I need to have some vegetables, or at the least, maybe go back to something a little bit more sustainable. When thinking about the different ETFs that are out there, sure, you can have your ice cream or you can have your Bitcoin ETF, but you can also have something a little bit more defensive or more balanced in terms of having more defensive capabilities or lower correlation to some of the higher octane stuff. And what we often find with people is as they go through that initial investing stage where everything's working out well, they're going pedal to the metal, they're eating as much ice cream as they can. Eventually there's a sugar crash and they say, hey, I need to do something a little bit more holistic, a little bit better long term. How can I build my diet with different things so that I have the balance? And so that's what we think about. And in particular, we do have some equity products that take advantage of some of the things that you described, but we really specialize, in my opinion, in providing that well-balanced support around the periphery, whether it's in fixed income, commodities, alternatives, etc.
Yep. And I realized my choice of words there may have been misleading. When I meant boring, I didn't mean, what I mean is the retail investor typically tries to go for stuff that just has a 10x potential the day after tomorrow. And with ETFs, even if it's boring, if you will, like there's a lot of reasons to have an ETF that has a certain exposure that a stock probably can't give you. And so that's really what I mean by that. And so you bring up a really good point. We've been doing a lot of talking about sector and group rotation, factor exposure, a term that to the self-directed investor is a completely foreign concept, but you step inside of any institutional investor, that's literally all they do. A lot of what you guys do, I would consider factor exposure. So maybe you can talk a little bit to that, because I am very concerned for the individual, a private investor, sort of 50 years and over, in terms of how they're currently allocated, given the tech rally. I really believe we're going to go back into a value overweight, real assets overweight for probably a decade plus now. And a lot of these investors are totally not aware, because their investment advisors are not telling them that, because they don't know or they haven't thought about it. And that can have profound differences, and I think implications to a portfolio at the worst possible time in someone's life. But I think what's cool about some of your guys' strategies, you can focus on a whole nother part of the market that you cannot do with a 60-40, 50-50 allocation. Maybe talk to that a little bit if you can, and then we'll go into a couple of specific strategies as well.
Yeah, absolutely. And I want to touch on one thing. When you brought back up the word boring, right? You think of like bonds, for example. Bonds are considered boring, but TLT sold off 50% in a year, right? So there can be a lot of volatility in these different asset classes. And there are ways that you can harness that volatility, which volatility works both ways, to the upside and the downside, regardless of what asset class you're in. So now going back to your question, when we think about this concentration and continued run up in passive investing, which is now the default selection for the average investor, right? Like 95% of new money that comes into the market comes in through a target date fund. They buy the same types of things, which predominantly tends to be large cap US stocks, right? That may seem prudent, but it's also the definition of a crowded trade. And when everybody's doing the same thing, you're not really diversifying, right? You're just chasing the herd, which again has worked out fine. But as we get into a more concentrated environment, and again, I think as investors, when you've lived through some experiences like the COVID crash, right, which was very short lived, but for some people, if you sell out at that bottom, you don't know when to get right back in. And so for us, we think about building portfolios that help you sleep at night. I certainly think about that. Like, I don't optimize for the best possible return ever. I optimize for the best return that I can get while still being a sane person. And so thinking about the different ways to pair exposures, whether you're shifting away from large growth into small value, or if you're just saying rather than be fully growth, maybe shift into value, like those are prudent things to do. And I think if you want to think like a financial advisor or like an institution, a really simple way to do that is just to rebalance, right? So when you have a winner that's run like large cap growth, right? You can look at it and say, okay, maybe every quarter or every 6 months, I'm going to shave some of those earnings off and go buy, relatively cheaper assets and give myself, one, a way to lock in some gains, but two, a way to buy cheaper discounted assets that ideally will allow for a more balanced portfolio. And you can do that across asset classes, right? Value and growth are just one really basic factor example, but you can think of this across stocks and bonds. You can think of it across stocks and bonds and commodities, other alternatives, right? Part of our evolution as a firm and of the industry is, again, to give investors exposure to stuff that normally they wouldn't have been able to get or would have been very expensive to get into. Whereas
Right.
now you can trade most of this stuff on a Robinhood account if you want to. And ideally, you just buy and hold. But
Oh,
yeah,
but that's fascinating. And I think that's actually exactly where I want to go. Before we look at a couple of slides, a couple of charts, if you will, and we look at a couple of specific strategies to give some good idea, maybe just touch on again the difference between an ETF and a stock, and maybe some of the advantages of an ETF strategy versus single name stock. I think that's something that a lot of people are still hung up on. Again, that's why they think ETFs are not as interesting to them.
sure. Yeah. And stocks can be fine. And in some cases, stocks are diversified businesses, but you still have sector risk. You still have company risk, right? You could have the risk of a CEO getting caught with his pants down, like physically. These are real risks when you're trading individual names that some ways you can quantify, but in other ways you really can. And so I own some individual stocks. I trade them tactically when it makes sense, but for the bulk of my own portfolio, I try and buy assets that have a meaningful long-term, you know, position in my portfolio and will balance each other out using the methodology that I described earlier, right? So an ETF can just be a more diversified way to play a thesis. And oftentimes, if you find ETFs that have positive or negative correlations to certain stocks or to certain themes in the market, that can be a really efficient way to get that exposure as opposed to trading something individually. I'll leave it at that, but there are numerous ways to handle that. I think correlations are one thing to look at. And then again, just the diversification. And in many cases, the cost of an ETF is so cheap now relative to what it's ever been to get a diversified portfolio that it really does make sense to own these types of things.
I'm a big believer, and it's really what we do all day outside of the once we've done the research, is really just build, manage portfolios with ETFs, and there's single stocks as well, but ETFs give us so much flexibility in terms of exposure, in terms of hedging, mitigating risks, that I think it's just a wonderful, wonderful tool. So having said it, let's look at a couple of charts now that you brought with you. I don't know, you have a couple of introduction slides, I think, on Simplify. Maybe just run us through a couple of those. And then I'd love to start looking at a couple of the strategies that you guys are running with ETFs that really are available on all the platforms. I should also say, none of this that we're talking about here is any recommendation or advice. It's really just through the lens of education. And Eric and I really just decided to do this from an educational perspective. And I just really believe in some of the ETFs and strategies they run, just as an FYI. But take us away.
Sure thing. So I already gave an overview of who we are, why we came to market, and what we believe. And so I won't spend a lot of time on that. But what I will say is that when thinking about how institutions are positioning their portfolios, they are often, number one, they're diversified, incredibly diversified. Number two, they're diversified beyond what you might typically be prescribed from a financial advisor, just a portfolio of stocks and bonds. And where they go next is in the alternatives bucket. So this can be all sorts of assets, right? I mentioned commodities earlier. It can be volatility, which is like insurance, either selling vol and being an insurance provider or buying vol and being an insurance buyer, right? It can be things like trend. So there's all these different types of exposures that institutions are using, and they're not only using them to provide more robust or defensive portfolios, but over time, as you mitigate drawdowns, as you operate in some type of rebalancing framework, that should give you better long-term risk-adjusted returns too, right? So it's a combination of defense and offense and being able to play both at the same time that really, again, as Simplify as a firm, we knew that there were very limited opportunities for retail and even professional investors to access these types of exposures. And we said, with these rule changes and with our expertise, we want to bring you all access. So, yeah, Serge, question
On
there?
that, Eric, just a quick point. You bring up a really interesting, you bring up the word alts. I think oftentimes in the retail community, people hear alts, alternative assets. They think, oh, it's a hedge fund or a private equity thing. It's really not. It goes beyond, way beyond that. As you say, it can be as simple as a commodity exposure or volatility exposure. And again, we can do a lot of that
Yep.
through ETFs. So just want to quickly go into that.
Yeah, no, I think that's actually a really important distinction. And one of the things that I would advise for anybody listening or watching is to know what you own in all cases, right? And so oftentimes alternatives can be very abstract or black boxy, right? And sometimes that's how they're designed. But in an ETF, holdings have to be displayed every day. If you're familiar with some of the larger illiquid alternatives that are prevalent in the market, some of the big real estate companies, private equity, private credit firms, et cetera, they're not bound to show you their portfolios every day. So the level of scrutiny, the level of audit is much, much lower. And oftentimes, which is things that look very good on paper and then have some type of nasty event, right? In an ETF, you can't hide what you're doing. The scrutiny and the availability of information to the market is incredibly high by design,
Yeah.
right? So moving forward then, and again, just on this alt topic, one of the rule changes that happened in 2020 is that second rule that helped us come to market allows for expanded use of derivatives within an ETF. And meaning in the past, you had to limit the amount of leverage you could use in an ETF wrapper. Now you can have much more exposure as long as you meet daily, what are called VAR limits, meaning you can't have too much leverage, right? So you're constantly being checked against some limit. And then as long as you satisfy that limit, you're okay. Prior generations of liquid alternatives have been what we call watered down, right? And the idea is that the products that have launched post 2020, they can take advantage of this new regulatory framework in which they become much more interesting or sort of less boring, right? So you can have a lot more fun in getting your exposure as far as having outcomes that are much more meaningful and value add to the portfolio. So a couple of examples of things that we do, and I won't go over this whole thing, but this introduction of the rule and really Simplify as a whole, and there's many other firms that are doing this too, taking advantage of this new ETF landscape to provide exposures that do things that you're used to, right? Like beta plus. So having some type of index exposure like the S&P 500, and then having a slight modified return distribution attached to it. Either buying some type of protection to protect against downside events, selling some optionality to generate some income, right? So there's a lot you can do around the traditional benchmark portfolio, but you can also then do other things like income generating portfolios that are using things like VIX futures, for example, or options, or you can have things like what we call structured beta, right? Where we'll go into the treasury futures market and we will, again, I'll use the term lever, but we will lever up exposure to different parts of the treasury curve. And so an area of the market where you couldn't have gotten a lot of movement before, a lot of volatility, now you can get much more sensitivity to rates or much more firepower, but again, doing so in the way you want it done and then pairing it together.
And so I'd love all the listeners to think about this. When you look at the self-directed investor, and we have institutional investors like investment advisors listening to this as well, and also, and of course, in the client base. But really, for the most part, particularly a self-directed investor, is essentially either directionally long stocks or maybe short stocks. Like it's a directional bet. And I talk a bit about this ad nauseum, how low probability a purely directional bet actually is if you think about it, all else being equal. But if you think about even like you bring up a simple example or a good example where let's say you long the S&P and you hedge it, like you can just buy an ETF for that. And a lot of people try to do all that themselves, more power to them. But I think a lot of people don't understand how much work goes into doing that properly. And so one of the things I'm trying to do is give people a look behind the scenes, how if they saw how much work goes into a proper strategy like that, they probably wouldn't try to do it themselves.
That's exactly right, Serge. And we get a lot of folks who they understand the mechanics because they maybe traded options on their own or traded individual securities or futures. And they will come to us and say, for the price and for the operational headache, I would just rather somebody else do it. And there's also tax efficiencies and tax benefits in the ETF wrapper too. So there's all of these things combined that we see very sophisticated investors come to us and say, look, I could do this on my own. I have done this on my own in the past. I want a packaged offering that can do it for me. Right?
Exactly.
So
that's exactly why I want to have this conversation. So let's talk a little bit about a couple of strategies that we discussed off camera that we thought we would bring to light. Again, just as an example, and I think starting with high, and just so you guys know, these are ticker symbols. So HIGH is actually a ticker symbol of an ETF. Just talk about this as an idea, and then again, that it's a provocative exercise that I'm really trying to do here. Give people really pause to think about, could they do this themselves? Do they want to do this themselves, like we just said? And all the advantages of maybe not trying to do that, and all the high blood pressure levels that can be avoided, and outsourcing that to someone else. Let someone else have high blood pressure, right? But talk about high a little bit and what that is.
sure thing. It's not a pot fund. So getting that out of the way. High is really a take for us. It's a way to have cash-like exposure via US Treasury bills, which for the first time in a long time are very interesting in that you can get totally risk-free, no rate volatility exposure for 5 to 5.5% yields right now. In the past decade or so, cash was trash. That was the saying. But Treasury bill and chill is a good approach these days. That said, people still want high income, right? They want distribution yields that are in the high teens, or I'm sorry, the high single digits, maybe the low teens. And they can get that in a few different ways, but anytime you're getting a yield above a treasury, you are taking some type of risk. And when you buy fixed income assets or bonds, you are typically adding either duration risk, meaning rate risk, or credit risk. And duration risk is how long does it take for me to get paid back? Credit risk is, am I going to get paid back at all? And then there's negative convexity, which we won't get into, but that's for mortgage bonds, right? So in high, what we do is we own a portfolio of treasury bills, and then we look to add a spread of income or spread of yield to T-bills that are generated from diversified option selling, right? So we look at the most liquid betas in the market, whether those are equities like the S&P 500 or the NASDAQ 100, whether they're fixed income like TLT, so long-term treasury bonds, maybe even gold, right? And we'll say, let's sell short-term spreads 2 weeks out that are, call it 5% out of the money. Meaning if the market or the index is at 100, we may sell a call at 105 for 2 weeks out. And that is typically a winning trade, right? Because your probability is that the option is going to expire worthless and that you're going to walk away from that. But sometimes you don't, right? And that's always the risk in selling options, is that you are going to be the provider of liquidity or the provider of insurance. Sometimes you have to pay up. And so what we do to mitigate that risk is we will buy an option further out. So think of that as like catastrophic insurance against your short position. And so sticking with the example in which I described us selling a 105 call, we may then buy a 109 call. And that gives us that tail protection, or what's called a tail hedge. And we just do this across the market.
Are you guys doing this on on ETFs, or are you doing on the actual underlying when you do this? Meaning, let's say it's on gold. Are you going out into the spot market and doing options on that, or even futures, options futures, or are you doing it on like GLD?
We prefer to do it on ETFs, although we will sometimes do it on indices. And like an index, say the S&P 500 SPX, selling options on those has tax benefits, right? So you can get 60-40 tax treatment, meaning 60% of your gain is a long-term capital gain, whereas 40% would be a short-term capital gain, as opposed to if you sold an ETF option, it's all short-term.
Sure.
So we do what we can to optimize for tax efficiency and liquidity. We won't go and sell all 500 of the S&P 500 names, for example.
Just quickly on that point, I have to add this because I'm sure a lot of people listening, they know that one of my bread and butter strategies to do exactly those options credit spreads you describe. One of the big things I always talk about, and I want to make sure there's no confusion here, I always talk about never using short dated options. So we tend to use 55 to 85 days, but only hold it for 2 weeks because I don't want the near term option risk. I used to also be a hedge fund analyst, and one of the things, and when you do that over time, blows up. However, and you guys are selling 2 weeks out, there is a difference here, right? You're doing this against a basket of T-bills. So I think people need to understand that there is a way to do this, and of course you pick your spot, right? But it also is what are you doing it against in that portfolio? And you're not doing this with 90% of your assets. You're doing it with the sliver against a portfolio of T-bills. Just need to quickly clarify, like I'm sure someone's head scratching right now about that.
No, good point of clarity. And yeah, for us, we are very focused on just providing a systematic, risk managed exposure with a goal of adding anywhere from say 2 to 5% above treasury bills a year in this yield premium, right?
So right now, that in case people don't know, that's roughly equating to 7 to 8% or so. Again, obviously it's not a guarantee, just that currently that's what this example with a goal would be.
Exactly. And that will fluctuate, right? Because sometimes if you're selling options, sometimes you're not always going to win that trade. And what I pulled up on screen for those watching or for listening is a chart of treasury bills in purple, right? So that's the T-bill ETF BIL against HIGH in white, and then the aggregate bond ETF in yellow. And so you can see by adding a little bit of vol premium on top of the T-bills, you're able to generate a decent total return spread, or we've at least been able to do that so far, a higher yield, which is shown in the bottom that we pass through to shareholders. And then if you notice, I put that core bond index in there, or that ETF in there just for reference, right? Bonds have been very volatile, both the duration component and the credit component, right? It's not to say that high is the perfect solution, but it's one of many ways to supplement or augment a traditional exposure of fixed income.
No, and the reason I gravitated towards this one as a talking point is, again, we do a lot of this. I do believe in selling options premium. There's a lot of risk in selling options premium if it's done wrong, but I think there's a lot of reason to do this against the bet of T-bills, particularly if they're already yielding you half of a decent portfolio return, 10%, 5% right now would be half of that. That's already pretty juicy. We're seeing a lot of the structured products community doing that as well, where they're taking the T-bill and chill approach and then selling some optionality on top of that with some barriers and whatever. To me, this is a cleaner way of doing it, and it's liquid. Try to get into a structured products. I can tell you it's hard to get out. I used to trade them for JP Morgan, and so this is a good one. Let's move on to the other one that we talked about. This is a very different, or two actually very different ETFs, but I thought we would talk about this one because right now I really think we're moving towards more of a hard asset kind of allocation, 5 to 10 years, sort of looking forward. Your ticker symbol is HARD. There you go. Maybe walk us through some of this. And again, I want everyone to think about, do you need to do all that trading and nervous activity when a lot of that could be done with an ETF? This is not an anti-trading commentary or podcast. I trade all the time. Eric does so as well. He's had before, at least to some extent, but it just can really, it's almost like outsourcing stuff. I'm a big believer in delegating and outsourcing in a controlled manner. So let's have a look at this.
Sure thing. And we don't have to cover both, but there are some overlapping features here. And really both funds or both strategies are trading commodity futures And what that is for those at home is it's just a way to get exposure to commodity markets where you don't have to take delivery of the commodity, right? If you're going to trade a head of cattle, I don't want to put it in my front yard, right? I'd much rather trade a futures contract that gives me the ability to either hedge or speculate on the price of cattle at some point. And there are a couple of different ways to do this, but our view, and I'll focus on hard because I think that for most people, they have an interest in just commodities only, right? Which for CTAs, a managed futures funds, we have both commodities and interest rates, but the strategies are very similar here. So with hard, we look at the most liquid commodity futures markets, and then we look to buy or sell them based on trend, right? And trend is really just for those listening and maybe unaware here, trend is just following something that stays in motion, right? So it's like the Isaac Newton of investing, where an object in motion stays in motion unless acted upon by an outside force. And that's trend investing. And so if something is moving up and to the right, you want to be a holder of it long. And if it's moving down and to the right, you want to be a short seller of it. And so in hard, we look at the most liquid commodity futures markets. We trade them or we own them or short them by trend. But we also factor in that commodities have a positive expected return on their own, right? And so if you owned a broad basket of commodities and you weren't trading any kind of trend signal, you would assume that you're going to get about a mid-single digit annualized return from that. That said, commodities are one of the assets that really trend well. And so if you're able to have some type of signal in place, either on the long or the short side, you can do very well. And that allows you to benefit in both inflationary markets when commodities are taking off, but also in disinflationary markets where inflation's coming down and commodities are weak, right?
Yeah, maybe we should add something there, Eric, if you don't mind. Tend to be mean reverting assets. It's a bit different than a stock or a company that can grow until it peaks growing and then it'll mean revert, but then the cycle's done totally, right? But commodities do really move in cycles, which is why the trending stuff. So this is we talk about excitement and not boring. This is where you're getting into almost a bit more of a tactical view of things. And again, not a recommendation, it's purely educational here. But if we think about moving into a world that has inflation that is well above the 2% mark for a longer period of time, with more of a geopolitical global divide, demographics also a very big deal right now, both sides of the Atlantic and in Asia too. We're looking at a very different world at the next sort of 5 to 10 years, and that's where something like this is interesting. What else do you guys do in here? Is it a purely CTA kind of strategy, or use any optionality around this?
All futures trading by trend. And so other than that threshold that I mentioned where you have to overcome the long bias before getting short, it's pretty standard. And what's interesting is we're actually, to my knowledge, we're the only commodity strategy in the ETF that can go short or does go short. You can get that in managed futures, but the difference between a managed futures and a commodity fund, as I kind of alluded to earlier, is that you'll have other assets in there, right? Whereas this is a pure play on commodities and can benefit from the structural features that you described a moment ago, right?
Well,
which
and
we
it's
saw
an
in
ETF.
2022, right?
It's an ETF.
Yes.
You just go to your broker account, type in a ticker, and buy. You subscribe to CTAs. It's a pain in the butt. It can be.
Yeah. Yep, absolutely. Yep. So we think that, to your point exactly, Serge, if we are in this higher for longer phase of not only interest rates, but also inflation as a result, or vice versa, we think that commodities are going to play a bigger and bigger role in client portfolios. And if you look back at the modern investment landscape, really post 1990, really when ETFs were first launched in 93, we haven't had many commodity bull markets, right? We've had one in the mid 2000s with the rise of China. But for most of that period, commodities have been a dud for investors. And we're seeing a reemergence of that asset class. And we could potentially be at the beginning of a really, I won't call it a super cycle, but a period where commodities can have a much greater impact on portfolios.
Absolutely. And then what could trigger that is the big picture thoughts you bring about. And then you think about the portfolio reconstruction. If the investment advisory industry, and by extension, before then, the institutional investors, will start changing simple equity portfolio allocations, the S&P will no longer be 40% tech. It really is 40% tech, like communications stocks, which are tech stocks, plus the XLK in ETF terminology. You're looking at 40+% tech. You don't have to go back that far. It was 20, it was 10, 15, and energy was 25. Now energy is 3 or 4%. So you're looking at like literally an 180-degree different portfolio composition that you have right now, and these portfolios the way they're right now are in grave dangers. I hope this was helpful here. Do you have any last thoughts, Eric?
No, I want to thank you for having me. This has been a really fun conversation, and we only just scratched the surface. So hopefully we get the chance to do it again. But if anybody ever has any questions, we are found at simplify.us.
Simplify.us. I really enjoyed the conversation. Definitely have to have you back. I look at this more as an open-ended sort of kickoff here, again, as we start delving into this world. And folks, any feedback, any questions, please let us know on all this or anything else going forward. And until next time, Eric, it was a pleasure. Thanks for being a guest here at the Study Wealth podcast.
Likewise.